Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sunshine Pharma Co. Limited annual report. Sunshine Pharma Co. Limited offers a diverse range of pharmaceutical products and services. At the forefront of their offerings are innovative treatments for infectious diseases, chronic conditions, and oncology. Their portfolio includes QA, a medication for influenza, and Dongwon, a treatment for hepatitis C. In addition to these specialized medications, the company also provides generic drugs that target infections caused by sensitive bacteria. These include clarithromycin, levofloxacin, and moxifloxacin hydrochloride. Furthermore, they offer active pharmaceutical ingredients, which are essential components in the production of various medications. Beyond their product offerings, Sunshine Pharma Co. Limited also engages in wholesale, retail, import, and export services for drugs. This comprehensive approach enables them to cater to a wide range of customers and meet their diverse needs. With its extensive portfolio and multifaceted business operations, Sunshine Pharma Co. Limited has established itself as a significant player in the pharmaceutical industry. Sunshine Pharma Co. Limited market capitalization of $25 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Sunshine Pharma Co. Limited holds a significant advantage in their industry. Sunshine Pharma Co. Limited trades at a higher price-to-earnings ratio of 71 times and a higher price-to-book ratio of 3.99 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 63% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the given summary. On the one hand, several factors contribute to revenue growth. A strong brand value and extensive market penetration enable companies to increase their sales and revenue. Precise marketing strategies and diversified academic promotion activities also play a crucial role in driving revenue growth. Furthermore, the development of a synergistic product portfolio can lead to increased revenue. The introduction of new products, such as the insulin series, has been particularly successful, with a 78.65% increase in revenue. The centralized procurement business has also seen steady increases in revenue and low sales expense ratios. International sales have expanded, driven by EU and US approvals in China, and the company's research and development capabilities have been strengthened in overseas markets. In addition to these factors, strong production capabilities and a reliable supply of QA oseltamivir phosphate for the Chinese National Drug Reserve have contributed to revenue growth. The higher incidence of influenza in the second half of 2025 has also led to increased market demand for oseltamivir phosphate due to its proven efficacy and strong brand reputation. On the other hand, several factors contribute to revenue decline. A significant decrease in overseas revenue by 34.7% is a major concern. Additionally, sales of chronic disease treatment drugs have decreased by 18.1%. These declines highlight the importance of diversifying product portfolios and expanding into new markets to mitigate risks and maintain revenue growth. The net income of the company saw a significant increase of 5.6%, rising from an unspecified amount to Rm 100 and 31.68 million. This growth in net income can be attributed to various factors, but one key contributor is the substantial rise in gross profit by 20.49% to RMB 3,685.4 million. The increased gross profit suggests that the company has been able to maintain or improve its pricing power and efficiency in production. However, it's worth noting that expenses also saw a notable increase of 12.3% to RMB $377.56 million. While this might seem counterintuitive given the rise in net income, it indicates that the company is investing more in various aspects of its operations. This could be due to strategic decisions aimed at driving future growth or addressing operational inefficiencies. Despite the increase in expenses, the profit margins of the company have likely improved. The significant jump in gross profit has outpaced the growth in expenses, suggesting that the company's pricing power and cost management are key drivers of its profitability. Overall, these changes suggest a positive trend for the company's financial performance, with net income increasing while maintaining or improving profit margins. The company's debt level has undergone significant changes in the recent period. While current liabilities increased by RMB 1,001,521 on page 32, non-current liabilities decreased by RMB 918,077 on page 33. However, a closer look at page 55 reveals that bank loans and other borrowings actually increased by RMB 1,001.52 million, representing a substantial rise of 45.7%. This increase is further supported by the fact that the total debt level has likely risen due to the increase in bank loans and gearing ratio on page 56. In terms of interest expenses, there are indications of a decrease. Finance costs decreased by RMB 95.83 on page 38, while total future interest expenses also dropped by RMB 54.22 on page 50. These reductions suggest that the company's financial obligations have become less burdensome in recent times. Management is optimistic about the company's future prospects. According to management, Yinfinidone has the potential to become the best-in-class treatment worldwide for IPF, and insulin glargine injection is expected to receive BLA approval in the first half of 2026. This indicates a strong focus on innovation and product development. In addition to product development, management is also committed to strengthening the company's core capabilities through the enhancement of its platform. The HEC Drug Intelligent Discovery Platform will serve as a key engine driving new drug discovery and development. This strategic move aims to elevate the company's research and development capabilities, positioning it for long-term success. Management is also looking to expand the company's international presence by boosting sales in China and building up research and development capabilities in overseas markets. This internationalization strategy will enable the company to tap into new markets and increase its global reach. Ultimately, management's vision is to transform the company into a vertically integrated world-class pharmaceutical company through innovation and internationalization. By focusing on drugs with huge market potential, the company aims to build a strong foundation for sustainable business growth. This commitment to innovation and expansion will likely drive the company's future success and solidify its position in the industry. The company's financial strategy has been focused on retaining earnings rather than distributing them to shareholders. According to the information provided, the company has chosen not to pay dividends to its investors. This decision suggests that the management believes in reinvesting profits into the business to drive growth and expansion. Furthermore, there is no indication of share buybacks being a part of the company's strategy. By not engaging in either dividend payments or share repurchases, the company appears to be prioritizing internal investments over shareholder returns. This approach may be aimed at maintaining financial flexibility and allocating resources towards strategic initiatives that can drive long-term value creation for the business. With concerns about inventory buildup and supply chain disruption, there are growing concerns about the state of supply chains, particularly with regards to inventory buildup and potential disruptions. One key indicator of this issue is the significant increase in distribution costs, which have risen by a staggering 60%, page 30. This escalation in costs suggests that companies may be struggling to manage their logistics effectively. Furthermore, data on finished goods inventory reveals an alarming trend. The number of finished goods held in stock has increased by 13%, page 45, indicating that manufacturers are producing more products than they can sell immediately. This surplus of inventory not only ties up capital, but also increases the risk of obsolescence and waste. The situation is even more dire when considering goods in transit, which have seen a massive increase of 77%, page 45. This surge suggests that supply chains are becoming increasingly clogged, leading to delays and potential losses for businesses. The cumulative effect of these trends raises serious concerns about the resilience of global supply chains and their ability to adapt to changing market conditions. That concludes the financial summary for Sunshine Lake Pharma Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.